All right, y'all, there are two ways to trade NVDA earnings, and I'm going to walk through each way to trade it. So up here on the chart, we can see NVIDIA is a beast, right? Overall bullish trend move, started to see some consolidation into the announcement. That allowed momentum to reset, a nice squeeze to be built in. And so all of this normally would make me want to jump in long to play this to the upside, but of course anything can happen around the earnings announcement. So there are usually two ways that I personally look to trade earnings. I either look for a premium crush, meaning that I'm not anticipating that much of a reaction, and so all the premium that gets built up into the options, I look for it to disappear and take my profit off of that. If you think NVIDIA earnings are going to be a non-event and want to play that premium crush style trade, what you typically do around the last hour, 30 minutes of market is you see where NVIDIA is trading at. Right now it's trading at 181.98. So a little bit closer to 182.50. So we'll go with that strike. And my favorite strategy to play for premium crush like this is an iron fly. That's when both short strikes on the call and put side are shared, and then you have two wings further out, and the idea is you don't get much movement, and so all this premium gets crushed. But of course we need to know how long to make the wings. What I do is I go up here to the anticipated range. Right now that's around 1072, so right by 11. And so usually I'd go out 11 points on each side. However, because it's a 2.5 strike increment, you can either go 10 points out on each side, as we see here, right? That's a little inside the anticipated range. 745 credit at the moment, 255 risk, so not a bad risk versus reward. And the idea is you're looking for that crush to happen, and you can take the profits the next morning if it ends up being a non-event. Now, if you like this idea, but you want to give it the full 11-point range, just bump out your wings one strike set. That makes a 1250 spread width on the iron fly. That's going to give you a bit better credit at 860, but it also means you take on more risk at 390. So it just kind of depends on what your risk versus reward tolerance is for this trade idea. But if you think it's going to be a non-event, that everything is already priced in and that this consolidation is going to remain through the announcement, or if you think there's going to be a pop move but it gets sold right back into the same range, we saw a similar move like that on last earnings here. You can see we had a pop up, but then by that day and then the following day, which would be Friday for us, it went right back into that range. The premium crush made for an excellent trade. Now, on the flip side, if you think it's going to have a volatile move like last time and stay there, or you're just going to look to take that quick win at the open if there is volatility and it's starting to pull back or, bounce up if it's a gap down, then this is the second trade idea. Personally, I like to play the volatile moves and the gap moves myself. That's usually my preference of these two earning strategies. And normally what I look for is to play the volatility. So I open a double debit vertical spread, or buy to open an iron condor, right? It's the same idea. So I go out roughly that anticipated range, and I look at the same spread width on each side, but a double vertical. So in this case, this is a 2.5 width spread. It's a $1.24 cost basis. So a $1.26 profit potential, pretty even risk versus reward. And the idea is usually when you see these gap moves on earnings, you get a move at least to the anticipated range, if not greater. Right? That's at least the majority of the time that I've traded earnings and played for the volatile move on symbols that typically get it. They usually move within or greater than the anticipated range. So the idea is if you can have your debit vertical spread in line with that anticipated range, and it's a greater than anticipated move, great. You know your spread's in the money. If it just moves to that range, then you're right at the money, should still allow for some sort of profit. If you like the idea but want to get a little bit better of a profit potential, you could always widen the spread. You can see a 5-point width spread. It brings that cost up to around 280, which means it's about a 220 profit potential. So just, once again, kind of depends on what your risk versus reward is. But this is how I usually look to play the more volatile move on earnings. Now, I would argue NVIDIA is kind of a mixed bag. It has times where it has both the volatility and the premium crush to it. There are other times where it, maybe had a little bit of premium crush at the start of the day, but then it just drops off and that volatility would have won. So it's kind of up to you to decide how to play it. So check it out. Let me know what you guys think, and let me know if you made money on this earnings. As always, my fellow Jedis, may the trade be with you, and I look forward to talking to you next time. Bye. Hey, Allison Ostrander here, Director of Risk Tolerance at Simpler Trading. Thanks for watching the video. If you enjoyed this video, please be sure to like and comment down below to help us out. Also, be sure to subscribe and click the bell icon so you can get notified when we release our next video. And if you want to watch us trade in real time using our own money, go to simplertrading.com to learn how to sign up. As always, may the trade be with you, and we'll see you in the next video. Bye.